Hello, welcome back to the show. I'm Mel Schaefer, and today I have Luke Lloyd with me, a recognized voice in finance and politics and the president and CEO of Lloyd Financial. Thanks for joining me today, Luke.
Good to be back in action, Mel.
So, to get right into it, I can't believe it's July already. We've just had Canada Day up here, and you have the 4th of July at the end of the week, and we have another earnings season kicking off later this month with Netflix and Tesla reporting. What do you think investors could be looking at into the earnings season, and even as those earnings start to come in?
Oh, absolutely. Earnings matters probably the most because we really need to understand how the consumer is feeling, right? How is the consumer spending their money? How is corporations handling these higher interest rates when it comes especially to the smaller and mid-cap companies that have to refinance their debt at these higher interest rates that we've felt for now about 2 years now here in the United States. But I'm excited for 4th of July to come around the corner because, I'm finally going to be able to slap my sticker. I'm going to be in the parade. I'm going to be in like my father-in-law's Mustang. We're going to be riding around, talking about Lloyd Financial Group. But what's interesting is from my Lloyd Financial Group, what we're kind of doing and thinking about is really what's going on the geopolitical side of things, but also what's happening at the top when it comes to the administration here in the United States, especially that big, beautiful bill, right? The big, beautiful bill is something that's kind of been top of mind. There's a lot of money being spent in a lot of these different areas. So what's happening is you're having this reshaping of the free market system where the government's spending all this ridiculous amounts of money, but it helps funnel money to these corporations. So whether it's the border spend, the defense spending of $150 billion through the big, beautiful bill, all of that is going to be reflected in future earnings. It's not going to obviously be reflected in this earnings report, but, I'm kind of curious to see what these big tech companies say, maybe some of these defense companies say, like the Lockheed Martins, Raytheons of the world, how they're factoring in all this government spending into their future earnings reports. That's going to be very interesting to see.
Yeah, so I wanted to talk to you next a bit about the political stuff. Trump's been openly attacking Powell and even floating the new Fed chair candidates. He blames Trump's tariffs for the delay in rate cuts. How do you think investors should interpret what this means for, interest rates, market volatility, and the broader stock outlook for the second year?
I've been very outspoken that, again, I have to position my client portfolios around what I think will actually happen, not what I think should happen, right? If I was the Federal Reserve Chair, I would have been cutting rates probably earlier this year because this whole debt Ponzi scheme can only last if the government can refinance their debt cheaper, if corporations can refinance their debt cheaper, and if personal consumers can refinance their credit cards, whatever it be, at lower interest rates to keep the debt Ponzi scheme going. So they were late to the game with hiking interest rates. I think they're going to be late to the game cutting interest rates. Look, Powell and Trump, they're not going to get along for a very long time because Powell politically himself cannot pivot hard because they lost so much credibility on the way up hiking interest rates. They can't lose more credibility by doing a quick pivot saying, hey, we were actually wrong and the economy is not as good as we thought it was, and cut rates. So I think we're probably only going to get 2 rate cuts, maybe 3 this year. We're not going to get that July cut, and Trump's going to be mad. Trump's going to be very angry. He's going to try to politicize the Federal Reserve, try to get Powell out of there, whether or not it's right for the economy or not, which, again, I think the path is lower. It has to be lower, and that's why you want to get ahead of the curve when it comes to investing. You don't want to be the guy or the investor or the person that goes and starts going longer duration when the time of interest rate cuts happen. You usually want to be ahead about 6 to 12 months of the rate cutting cycle. So, yeah, we got the jumbo rate cut earlier last year. That could have been maybe the start of the rate cutting cycle, but we haven't really seen much since that jumbo cut of 50 basis points back then. So I think we will start the rate cutting actual cycle towards the end of this year. It will be a consistent rate cut cycle as we head into 2026, and that will be very beneficial for those longer duration stocks, whether it's the dividend payers or even longer duration bonds like the TLTs of the world. So, I like utilities a lot. There's 3 tailwinds there. Lower interest rates is a tailwind. The AI demand for energy is there. The heat waves going on in all around the world right now is bullish for utilities and commodity prices. So energy, utilities, these longer duration dividend payers, I think that is the spot to be. I think the big tech has had such a run for such a long time. All of those other areas need to catch up, especially as the rate cutting cycle happens.
So I was going to ask you a bit about tech next. Tech stocks have been leading the charge again this year. We have got the stock market making new all-time highs. And Or do you think we're setting up for another AI-fueled melt-up, or do you see risks of a pullback?
Yes, but it's just in different areas. It's not going to be, I don't think, in like the Microsofts, Amazons, Googles of the world. It's going to start spreading out a lot. And that's why another reason why I'm so bullish on nuclear energy and so bullish on natural gas. So like Cheniere Energy, Kinder Morgan, are all both stocks my clients own. XEL Energy is another stock my clients own around renewable energy and also specifically natural gas. Nuclear energy, you can own uranium, URA. You can own Cameco Energy, CCJ. These are all areas where I'm actually playing the infrastructure side of AI because from my data and from things I'm reading and my kind of connections, I'm seeing that AI demands like 8 times over the current infrastructure output. So that demand is not going to leave. But the problem is everyone's just thinking on the top level and a high level kind of standpoint of who are the actual players, around AI, like the NVIDIA's, Microsoft's, cloud computing platforms. But like, there's all these different areas, like I said, like energy prices or energy. There's also the data center REITs you can think about buying, right? So there's all these different areas. That's where I'm looking to buy for my clients, even implementation of artificial intelligence, like Accenture, one of the biggest consulting firms in the world. Every company out there is going through this AI revolution because of all the productivity boosts. It's going to increase their margins. They're calling companies like Accenture to implement. Accenture just sold off last week, so I'm thinking about buying more for my clients actually around that.
So another thing I wanted to just touch on, I saw a clip recently where you talked about late stage capitalism and what that means for the global economic order. Can you explain for our audience what that means and why do you think it makes the current environment risky?
Man, I could talk for hours on this one. So this goes back to, and I'm just, again, citing what I've grown up in, and I'm citing, the United States history, because that's what I know, right? But 1913, Federal Reserve being created. You can talk about 1971 officially getting off the gold standard. All of these things, especially the more the government gets involved, it usually funnels money to the top. So the rich get richer, the middle class tends to separate. And this has actually happened many times throughout history. It's not the exact same, but you can look at the Dutch Empire, the British Empire, the Roman Empire. You can look at all these different things and usually kind of ends the same way. And what happens is there's a big wealth disparity. We're at the point where the government, and again, I'm all for free market capitalism, but my problem is the free markets really haven't been able to operate pretty fairly and pretty free. It hasn't really incentivized small business owners to get ahead. It's really incentivized the subsidies and tax credits, whatever you want to call it, those larger corporations getting bigger. So now we're at the point where the large are so large, the too big to fail kind of comment, the large can go in and acquire small businesses. The large can continue to generate all this cash flow and just own basically everything. So we're at the point where, now in America, it takes 2 people working to afford an average house. And most people can't even afford the average house anymore. Back in the day, you were able to have, 1 person working and be able to afford a house, right? So we're at such a point where there's so much wealth disparity that capitalism actually inherently creates socialism in some ways. So what I mean by that is people start voting in policies, social safety nets. You also have on the other side this AI thing, right, where it's going to start replacing jobs. So if systematic unemployment goes up, that means you actually have to take care of more people, whether it's welfare, whether it's food stamps or other social safety nets. UBI, in my opinion, is probably right around the corner. So capitalism, late-stage capitalism, actually inherently creates socialism and communism in some ways, and then the whole system kind of implodes from there. So again, I think this is maybe 60, 70, 80. This is a long, long time away, but the transition you can clearly see happening. And it's going to be very interesting to see, how it happens, what exactly happens. But in this process, what tends to happen is the rich get even richer. So those that own assets, real estate, stocks, businesses, those are the ones that actually take part in that wealth disparity even more. So that's why when the worst case is sometimes the best case for investors in some ways. So that's kind of my mentality on, when my clients are so scared about the future, I am too. I'm sometimes afraid. I'm thinking about having kids soon. I'm afraid for the future as well. But the worst case is sometimes the best case when it comes to the actual money side.
Yeah, so I want to talk a little bit more about that in terms of the stock market. Retail investors have been sort of chasing these big mega cap stories, but we're seeing a bit of a quiet rotation into value and small caps. Where do you think the opportunities are in those smaller companies?
Yeah, no, I think the opportunities are a lot, like I said, in the AI realm of things, the electrification of everything plays, energy plays in the small mid-cap companies. Like I said, XEL Energy is one of those that we own, and it's around the energy and smaller, it's a mid-cap company. Aspen Aerogels is one I've been kind of outspoken about. They kind of create the battery technology and a gel that goes around the batteries, makes them more efficient, produces more energy. So I think it's all around, again, the small cap tech space, the small cap energy space, all of those different sectors around, because a lot of these companies have so much debt on their balance sheets that some of them are starting to go out of business. But if rates do go lower, small caps are going to rally a lot harder than those larger cap companies. Because what people don't understand is when the Apples, Microsofts, Googles, Amazons of the world have hundreds of billions of dollars in cash in their bank accounts, that interest on their cash is earning billions of dollars. So higher interest rates actually helps the big tech companies. Lower interest rates actually helps the small cap companies and you refinance your debt. So those are areas I'm looking into in the small cap space.
So talking about your investment thesis, you recently launched Lloyd Financial Group, and on your website, you say you believe in no sugarcoating and no empty promises. Can you talk a bit more about your investment thesis and how you want to change the client experience?
Absolutely. So this world is full of a bunch of chest out Wall Street guys, right? I'm kind of the guy who comes from blue collar, coal mine, steel mill, small town mentality, right? So I'm trying to incorporate that blue collar grit into how I kind of build the business, how I think about investments. I'm going to be blunt and kind of, not kind of sugarcoat, tell you when times are good and times, I'm going to tell you when times are bad as well, right? That kind of mentality. But I think the overall world, there's a bunch of financial advisors out there that just say, hey, if you look at history, the stock market only goes up. Like, hey, if you've been in the stock market for 40 years, you'll compound your money at 7, 8, 9% a year. Well, that's all fine and dandy when you only use history as a gauge for the future. But the problem is the things we are dealing with now, at least in American history, has never happened before in the history of America. It has happened in other nations and other empires before. And that's where I'm trying to study and say, hey, whether you're 65, 70 years old now, we got to think about all this stuff and how maybe we can use history, not American history, but other cycles throughout history as a gauge for the future. But also, how my 25, 35, 40-year-old clients that have 30, 40-year time horizons that are more susceptible to maybe bigger changes on the macro scale of things, especially when you have China, India, these other kind of countries, Russia, these other countries coming up, becoming much more closer to a geopolitical enemy in many ways. We have to consider that the United States has been the world reserve currency for hundreds of years, right? I mean, for a very, very long time. We don't know what it looks like or feels like if that was ever to change. Or, we're used to other countries buying basically all of the treasury bonds here in the U.S. Well, if other countries perceive our debt to be risky because of our fiscal irresponsibility, well, then we have to consider that into the equation. So my point is, I'm not going to be your financial advisor that says, hey, for the next 40 years, just buy the S&P 500 passive index fund and just set it and forget it, and then we'll be all cherry and happy and rosy down the road. I think there are some things we really need to pay attention to really truly be a fiduciary in today's world as a financial advisor.
Yeah, and I know on your website it also says that that people need to have fighters in their corner every single day. So just lastly, Luke, I want to ask, what is your top priority for your firm into the end of the year?
I think my top priority is being that person, if we're talking about me being a financial advisor and kind of how I approach my business in many ways. A lot of people are so stressed out. Stress is the number one factor when it comes to wealth and wellness. Wealth is just one side. The wellness side is another. Everyone's so stressed out about, we're so connected, social media, TV, radio. You hear all these different things. Everyone's so concerned. Of course, the news cycle is always trying to scare you. I'm not trying to scare anyone. I'm just kind of telling you what I'm thinking about, right? But my point is, I'm always trying to be that financial doctor. I always say my clients are always trying, I always say to my clients, you're able to sleep at night because I'm not able to sleep at night, right? I want you to sleep at night because I'm your financial doctor. I'm the guy that's going to be taking care of you, dealing with the stressful things, so that way you don't have to, right? But I think as we head into the next, like I said, 4 or 5 years, the biggest thing we need to pay attention to is if any point in time the debt liquidity cycle ever was taken out, if we actually do balance the budget, we've been addicted to all this debt for so long. I think it's really important to really focus on this dividend payers, good balance sheet stocks, because if any kind of correction happens, all that speculative money is going to come out of the markets, especially in some of those higher tech names, if that makes sense.
Yeah, well, as always, Luke, it's great to have you on the show. Thanks so much for taking the time to join me.
Thanks, Mel.